So the next area to focus on is receivables. And here we're going to look at credit policies and effectiveness of our collection efforts. Receivables exist because we allow customers to buy our product without paying us in cash. And that's necessary because it's customary for businesses to work on credit. And furthermore, it removes one obstacle in getting the sale. We just have to make sure that we grant credit to the credit worthy and that we are diligent in collecting money from those who owe us money. Some tools that we have relate to credit policy. They might be, what are the standards? What constitutes a worthy client to grant credit? If somebody has very poor credit and we sell them our products on credit, guess what? We're going to lose the goods and not collect the receivables. So we don't want to sell to people that cannot pay us. Second, what is the period of time? When is it due? Is it due in 30 days as customary? Or can we somehow make it net 20? Not common, but perhaps that's possible. What we want to avoid is, and fight off, is any attempts from the customer to negotiate the other way towards 60 and 90 days. We want to stick to 30 days if possible, shorten if possible, but stand firm on 30 days to avoid delaying the cash coming to the company. The third way is to perhaps give them incentive to pay early. The discount that's most customary we see is 210 net 30, which means 2% discount if you pay in 10 days. Otherwise, you owe all of it in 30. That's what net 30 means. The collection policy is also an important aspect of managing receivables. Do we let people just pay us when they get around to it? Or can we remind them that they owe us money? Or send them invoices in a timely way so that it starts the clock sooner? Or can we create some disincentives for late payments, such as interest or late payment penalties? So the decisions are not just from a credit manager. It should include senior management as well, because if we tighten credit too hard, we may jeopardize sales. If we loosen credit too much, sales may rise, but our bad debt expense would also rise. So we want to make sure that we have all perspectives, from the credit manager to the CFO to those in charge of sales, and possibly the CEO, if it's controversial or a difficult decision. In the next example, we're going to use a technique called aging to look at how healthy are the receivables. And here we see on the bottom that we have aged the receivables, which means we take the total receivables, in this case $1.9 million, and we split them based on how old they are, from 0 to 10 days, which is quite current. We wouldn't expect to collect all the money that quickly anyway. Then we get to 11 to 30, we'll have some there. And then as we go beyond that to 31, 46, and over 60, we want to make sure that we don't have a lot of money tied up in old receivables, because the longer the receivable is outstanding, the less likely it is that we'll collect. And if you compare the two hypothetical companies here of Superset and Wonder Vision, we see that they both have 1.9 million, but doing this aging really exposes the problems at Wonder Vision, because look at the bottom. We have 288, 192, and 38, so that a total of 27% of receivables are older, compared to 0 for Superset. So they're able to collect the receivables very quickly, some even earlier than 30 days, but all of them by the end of 30 days. So they have similar numbers on the very bottom, but one is performing poorly and the other is performing admirably. So this is what an analysis, very common, we see it in most companies, an aging analysis, and it allows us to make sure things are managed properly. Accruals and accounts payable is the third element of our CCC, and we also had called them spontaneous liabilities, because as we grow the business, vendors will allow us to owe them more money. That's why it's spontaneous. So in the area of accruals, these arise when the company owes money to other parties. It could be employees, like an accrued wage or bonus. It could be taxing authorities, like accrued income taxes payable, or it could be warranties, a reserve that we set up for warranties given the sales that we had in this period. The second category are the accounts payable. These are direct items that we owe to the vendor who have allowed us to pay them with some time, typically 30 days. So the illustration we'll do here is, what would happen if you had a discount offered to you? Your vendor says, if you pay me within 10 days, you could take a 2% discount. Otherwise, it's due in 30. So you say, is it worth it for me to pay early? And here's the calculation to evaluate that. we have a purchase of $25,000. The 2% of $25,000 is $500. And therefore the true price, if you will, is $24,500, because we can think of it as if we pay quickly, we get $24,500. Otherwise, the interest that they charge is $500 for that extra 20 days that get us from the 10th day to the 30th day. So that's what we're looking at. Should we let the vendor finance us for 20 days for $500? And here's where we do the calculation. Here, we take the periodic cost divided by the discounted price. And that is the interest cost is $500 divided by the true price of $24,500. And we multiply that by how many periods that is in a year, because we want to annualize the rate. So we take 365 divided by the 20 days. And there are 18 of those in a year. Just roughly 18 times 20 days is 360 days. That makes sense. So if we do the calculation of the interest cost divided by discounted price, and we multiply it times how many repetitions we get in a year, that turns out to be a 37% rate of interest. So therefore, if we could borrow money at lower than 37%, we should definitely even borrow money to make the payment early. And interest rates are nowhere near 37%. So the general rule is if you're offered the 2%, you should take it. You could do the calculation once in a while to check, but we're so far in one direction that it's unlikely that the answer would turn out that it costs you more money to borrow than 37%.